The last few quarters have brought a major slowdown to the growth of the EV market, which was so significant that the last year ended nowhere near the expected. Welcome to Evolution Tech, where technology meets tomorrow. Leading the charge into the ever-evolving landscape of electric vehicles, EVs, and groundbreaking green technologies. In terms of projected sales numbers, EVs still account for less than 8% of all new vehicles in the US, and with such dynamics pretty much everyone is in panic mode. Car makers are postponing their EV investments. The government and the EPA are now coming up with less optimistic plans, while dealers are anything but happy to see EVs sitting at their lots for months. In other words, the EV market crash is here, and there are 7 clear indicators, so make sure to stay with us and take a look. Number 7. Change of plans. Possibly the biggest indicator is the recent change of plans that the EPA and Biden's administration announced. To remind you, last April the EA came up with a proposal with strict emission rules that would eventually lead to massive electrification in the next few years. The plan was to make 2/3 of new vehicles all electric by 2032, but with the current dynamics there was no other option but to make some revisions. Therefore, we recently found out that a new plan is coming, and this time the goal is to make 50% of new cars electrified, and as details are still a little bit unclear, some experts suggest that this 50% actually refers to all kinds of electrified vehicles, which includes hybrids and plug-in hybrids as well. One way or another things are clear. The government indirectly admitted that the original plan was rather wishful thinking than something that would come as a result of detailed research and projection. Moreover, many experts believe that with the current growth, even this changed plan will soon require further revisions, pointing out that there were still decades away from EVs holding half or more of the market. Number 6. Huge price cuts. The moment EV growth slowed down, automakers were aware that they needed to do something, otherwise all their plans based on unrealistic projections would soon become a disaster, and in circumstances where dealer lots are full or supply exceeds demand significantly, the only way was to boost sales somehow. Of course, the easiest way was to cut prices, so we've been witnessing massive discounts in the last several months, especially when it comes to high-end luxury EVs. Ford is one of the best examples. The Blue Oval company started offering massive discounts on the F-150 Lightning, and buyers can now save between $7,500 and $155,000. Retail incentive offerings and the so-called $7,500 BOS credit. But even with that massive discount, Ford doesn't expect some crazy sales numbers. No, they already scaled down their production by half for this year, so it's quite obvious that the primary idea is to get rid of those EVs that are trapped at dealer lots. Tesla was the first company to start this practice, and as the only high-volume EV maker in America, it's obvious that the plan was to force legacy car makers and other startups to lose even more money due to the inability to optimize production. These car makers were already losing money on EVs, so this only elevated the problem to the next level. Consequently, companies like Ford ended up losing at least $36,000 on every F-150 Lightning they sold, with a total loss of around $1 billion only in 2023. Now these companies are pushing their EV investments back, which we'll talk about in a few moments, which only means that there will be an even greater gap between Tesla and other EV makers in terms of technology ability to make profit. etc. Number 5. Dealers don't want to sell EVs. Currently there's a huge imbalance between the supply and demand in the EV market, and it's not hard to guess who's suffering the most. Dealers, of course. Their lots are full of EVs, and according to the most recent data they need almost 120 days to sell out their EV inventory. For comparison, the number of days is 71 when it comes to gas-powered cars, which is pretty close to what is called ideal, and that's a 60-day inventory. In other words, EVs are slow sellers, so dealers need more time to sell. Moreover, they need to put more effort, because while gas cars are usually bought after one visit, EV buyers usually make 4 visits before they decide, which means that salesmen have to spend 75% more time to earn their commission. Then there's the matter of markups, which are impossible with such a slow demand. On top of everything, car makers are requiring huge investments. Dealers need to spend hundreds of thousands, sometimes over $1 million on chargers, training, and other things. Most of them don't want to do that, so it doesn't surprise that Buick has lost half of its dealers only in the last year because of GM's crazy ultimatum to sell electric cars. Number 4. Reliability issues. Another big reason why the EV market is slowing down and the whole industry could collapse in the future is because customers are afraid of purchasing EVs for obvious reasons. It turned out that EVs are nowhere near as reliable as some claimed, and that they cause 80% more problems than gas-powered cars. Battery and charging trouble, software issues, bad build quality. Those are just some of the things that EV owners complained about, practically except for Tesla, which is close to the industry average in terms of reliability. No other automaker has managed to make a reliable EV. To make things worse, the cost of repair is much higher with EVs, which consequently leads to higher insurance costs and poor resale value, as the recent surveys show that EVs lose half of their value in just 5 years on average. Startups are almost dead. Not so long ago, many experts claimed that EV startups are some of the best places to invest money. However, that's not the case anymore. EV startups are about to collapse soon, which is yet another clear indication that the EV market crash is starting. Just take a look at America's 2 most promising startups, Rivian and Lucid. Rivian was backed by various powerful investors including Amazon and Ford, and even though it already released a couple of pretty exciting EVs, it struggled so much. Only in the last year it's been losing $40,000 on every vehicle it sold, which led to an estimated total loss of $5.4 billion. Lucid is also in big trouble as it lost over $650 million in the last year. The reason is clear: they're not selling enough EVs and they haven't optimized their production. Rivian sold 57,000 vehicles in the last year and doesn't plan any increase for the next year. Instead, it'll lay off another 10% of its workforce to minimize expenses. As for new investors, it'll be very hard to find them because the shares are in free fall. Only in the last week they went down 20% for both companies. If things are still unclear to you, just compare their values 3 years ago and today. In 2021, Rivian and Lucid were worth $153 and $91 billion respectively. Today that value is $10 billion in Rivian's case and $6.9 billion for Lucid. Number 2, legacy car makers don't have money for new EV investments. Just like startups, legacy car makers are losing millions on EVs. We already mentioned Ford and its billions in losses, but the Blue Oval company is in an isolated case. Others are suffering too, and that brought an interesting trend lately. With market slowing down and other factors in mind, legacy automakers had enough. They're not ready to invest in EVs anymore and lose even more money. Instead, they're postponing their investments indefinitely in order to save what can be saved. Once again, we can use Ford as an example with this decision to cut the production of the F-150 Lightning by half, but that's just the beginning, considering that the company made a decision to postpone $1 billion worth of EV investments planned for this year. Things at GM aren't much better either. The chronic lack of profitability caused some pretty interesting decisions, such as the delay of the most important EV prospect for the future, the all-electric Silverado and Sierra pickups. Their production now won't start before 2025, while the production of the new electric drive unit has been postponed for at least 9 months. Number 1, customers are turning back to IC cars. A certain number of American consumers bought an electric vehicle while others got the opportunity to hear first-hand impressions, and it turns out that EVs are nowhere near as good as advertised. The ownership issues are numerous, starting from higher than expected running costs, problems at charging stations, range anxiety, and low reliability scores. With all that in mind, it doesn't surprise that the percentage of drivers who are dedicated to going electric dropped from 81% in 2021 down to 52.1% in 2023, according to a recent study. The same study also showed that only 37% of Ford Mustang Mach-E owners went for another electric car. On the other hand, nearly 46% purchased a gas-powered car, which clearly indicates that consumers are not interested solely in things like zero emissions. Things like vehicle type, convenience, and capability still matter the most, and in these aspects electric cars obviously still aren't as good as their internal combustion powered counterparts. Thanks for watching and see you next time.